What is return on equity ratio? What does return on equity really signifies? Which key financial performance metrics are responsible for driving the return on equity ratios higher or lower? Are there any shortcomings of the same? Hello everyone, I am Sumit Kansal and I'll answer all these questions in this video. Also, we'll discuss the basics and in-depth understanding of return on equity ratios, which can be very useful to analyze a company. Mathematically, return on equity is defined as the ratio of the net income and the shareholders' equity in a business. Return on equity is the measure of financial performance of a company. Let's understand what we mean by net income and shareholders' equity. Net income is the amount by which the total revenue exceeds the total expenses of a company for a given period of time. Total revenue in general includes different elements like earnings from sale of goods and services, interest income, income from sale of a business, or any other income which will be varied from company to company. Similarly, total expenses includes the cost of goods and services which are sold, operating expenses like salaries, wages, office maintenance, utilities and depreciations, interest expense on any debts and the taxes, or it can be any other expense for a company. Shareholders' equity or equity is also called book value of a company. To simplify and keep it easy, I'll refer the shareholders' equity as equity for the rest of the video. Equity represents the amount of money that would be returned to shareholders if all the assets of a company were liquidated and all the company's debt was paid off. Equity can be calculated by subtracting the total liabilities from the total assets of a company. Total assets include both the current and non-current assets. Similarly, the total liabilities are composed of current, which is now commonly known as short-term liabilities, and the long-term liabilities. Equity is a very important concept and criteria to analyze the company and company's management's decisions. If you would like to know more about shareholders' equity, for example, how it can be increased or decreased, and what all actions from a management affected, and why consistent growth of equity is a good sign on company's balance sheet, please let me know in the comment section and I will come up with a video on it. As we know now, equity is net assets in a company. Return on equity can be considered as a measure of how effectively management is using the company's assets to create the profits for the company. Let's go a step further and deep dive into the DuPont analysis. It decomposes the return on equity ratio basically into three drivers. This technique will give us an opportunity to focus on the key metrics of the financial performance and to understand why return on equity is so important and how it is composed and what key factors are driving it. The first driver is the return on sales, that is net income generated from the total sales, which also represents the operational efficiency of a business. This ratio would be higher with higher profit margins and also with the lower operational cost for a business. Second driver is the assets turnover. It measures how efficiently a company uses its assets to generate the revenue. For example, imagine a company which had $100 of assets and it made, say, $1,000 of total revenue last year. The assets were able to generate 10 times their value in total revenue. That is, the asset turnover ratio for that company would be 10. Higher the ratio, better it is for the business. Third driver is the financial leverage. It is a very important one. It is an indirect analysis of company's use of debt to finance its assets. Higher the debt a company carries, lower is the equity, which increases the leverage ratio. As a result, it would increase the return on equity ratio, but that's not necessarily a good thing. In general, higher the return on equity of a business, better it is, but we do not want the leverage ratio driving it. This is an extremely important driver as financial leverage is the only one out of three which takes into account the financial risk associated with a company. On the other hand, not using any leverage could put the company at a disadvantage compared to its peers, so balance is needed when it comes to financial leverage. Return on sales and asset turnover are the profitability ratios of a company, and combined value is also known as return on assets. Clearly now you can see that return on equity ratio is driven by a lot of important parameters of a business. Hence, it is an extremely important ratio to be taken into consideration when analyzing any company. And this ratio can be used as one of the key parameters to screen quality businesses. Also, we know that a business with high debt can end up boosting the return on equity ratio. Hence, we cannot decide to buy a business solely looking at the ROE value. Another important and closely related ratio is ROCE, which is the return on capital employed, which also takes into consideration the depth of a business. If you would like me to explain the differences between ROE and ROCE, or even if you would like me to make a video on different topic, please leave a comment below. If you liked the video, please do consider liking it and subscribing to the channel for future notifications. Thanks everyone for watching, and I'll see you in the next video.